Hello, everybody. How are you? Have a good day. This is still MC, the accountant shares, and this is the continuation. This is like part six already of installment sales. Installment sales is quite a long topic, actually, or chapter. And this is all about allocation of cost of goods sold. So the situation here is that what if, for example, a company is using periodic inventory system and all inventories are lumped together as one? Now, if we have perpetual inventory system, normally the different types of cost of goods sold are already reflected for each. So example, again, there are two major types of sales. We have the regular sales and the installment sales. So installment sale is actually under special sales. We will know more on special sales. And then, for example, for the allocation of cost of goods sold, the problem would arise, especially if we are using periodic inventory system. If we are using the perpetual inventory system, there wouldn't be much of a problem on the sense that the inventory balances are already allocated depending on the type of sale. So if the sale is, for example, under regular, which is composed of cash sales and account sales or credit sales or term sales, those are the terms for the second one. Special sale would be, example, in the topic here or this topic, that is installment sales. So perpetual, there wouldn't be a problem. The problem would arise if ever we are under periodic inventory system because there's only one cost of goods sold and we have to know how much of that particular cost of goods sold belongs to cash sales, belongs to account or credit or term sales, which is under still at or with regular sales. And another one is the installment sales or the installment sales. And so allow me to discuss now. So allocation of cost of goods sold, as explained, that is the background. So the allocation is normally made based on the relative cash price equivalents of the cost of goods sold or cost of sales or goods sold. Meaning to say, whatever is the price of the respective type of sale, such would be converted to make sure it is under the cash price equivalent. Now, if the sale is cash sales, no problem, no adjustment should be made because whatever is the price is already stated at its cash price equivalent. The problem or issue would arise if ever we are talking here about account sale or credit sale or term sale. Again, those are just three same terms, and a special sale, that is installment sale, which is our topic. So how do we adjust them to become cash price equivalent? Remember, those prices or the selling prices for the latter two types of sales, again, account sale and installment sale, are higher, percentage higher than the cash sale prices or relative selling prices. So for sure, among the three, as explained by me in the introduction, that out of the three types of sales, the first one, cash sale, will have the lowest, followed by credit sale or account sale or term sale, and finally, the highest would be the installment sale. So in terms of prices from highest to lowest, installment, account, or credit or terms, and cash sale. So why is this important? Because later on, we have to adjust the two higher amounts to become consistent with the cash sales. Okay, so there are three probably situations in which we are going to translate the prices, but this is going to depend upon the source. The source here is still Milan. Probably we can visit with other textbooks like Guerrero and so on, wherein he has several situations. So for the relative cash price equivalents, these are the given cost of goods sold, one item 1,200,000, and these are the sales. So We have from regular and installment. The regular is not subdivided into cash and account, but there are problems wherein regular is really separated. And so the question is, how do we compute for the allocation of cost of goods sold, or how much would be allocated to the two types of sales from the cost of goods sold? Firstly, we have to translate the price of installment sales so that it will be consistent with the regular sales. Why do we have to translate? Because our allocation would be distorted. Since we know that installment sales has selling prices higher than cash selling prices. So as said, it is higher by 20%. Therefore, the 2.4 million or M here, 2.4, should be adjusted to become 120% lower than its original selling price. So this slash here is not correct. It should be 2.4 million. We have to divide it by 1.2 to become 2 million. So we add the two, meaning we are going to develop fractions out of the sum or total of the cash sale prices or selling prices, which are already adjusted at their cash price equivalents. And we are going to multiply these fractions to the total cost of goods sold. So if we multiply 1/3 to 1,200,000, that's 400,000, and 2/3 would be equal to 800,000. And we also get the total of 1,200,000. So it's going to be easier to check or spot. Okay, so that's how we obtain the relative cash price equivalents. If ever it's already stated in the problem that the amounts are already at their cash price equivalents, or they're already adjusted, or the problem is silent, normally we're just going to make use of the amounts, whatever given amounts, and develop fractions again and allocate the total cost of goods sold based on those fractions. Okay, hopefully that is clear. Next, illustration 2, consistent markup on regular sales. Okay, so normally a company has regular sales. At the same time, there would be installment sales. So we have here the given information. Additional requirement would be how much would be the total realized gross profit from regular and installment. As said, the total realized gross profit from regular would be the difference between sales and cost of sales, but the realized gross profit for installment sales would be the result when we multiply collections, whatever total collections would be, down payment, traded in merchandise at fair value or actual fair value, or estimated one if the fair value is not given, and the installments coming from the receivables. Okay, so those are the three sources. All right, so let's compute now the realized gross profit. However, we need to know first how much is our ratio, cost ratio for the regular sales, so that we can compute our installment sales. Okay, so how do we make this simple? Remember, if we have two types of sales, then we also have two types of cost of sales, and we also have two gross profits, right? Gross profit from regular is entirely realized because that is under PFRS 15. Installment sales is deviation from PFRS 15. Therefore, we have to use the concepts that we have learned prior to the other sessions or with the other sessions. Okay, so remember, we need gross profit rate to compute the realized gross profit for our installment sales. Okay, so we need these two rates. And then prior to that, we need to know first how much is the cost of goods sold that is to be properly allocated to the regular and installment. So what we did here was we first computed the cost of goods sold as a whole. So we have here the items for inventories, inventory purchases, requisition, that's to be added to equal to goods available for sale. And then the inventory ending balance would be the new and repossessed. So you have here 475,000. And so the total cost of goods sold would be equal to 2,665,000. Then we allocate. So question is, how do we allocate, right? So let's check for some clues. The gross profit on regular sales as given is 30%. And then, which means that the cost ratio for regular sales is 70%. We have here regular sales at this amount. If we multiply that by 70%, we get the cost of sales for the regular sales. So that's why we obtain this amount. This is the total cost of goods sold. If we deduct the goods sold or cost of it from the total cost of goods regular and installment, so we get the cost of goods sold for the installment. And then we have here the, or what? Mabalong na mabi, kaya madungog, yung mga ting madungog diri. Padung na. Okay, so installment sales in 20x2 is given this one, 2,125,000. Okay, that is here given. And if we deduct the cost of goods sold that we obtained, 1,317,500, that is the gross profit for installment sales. Should we divide that by sales, that is 38% gross profit installment sales. Now, there are basically two installment accounts receivable, and if we see those two, it only goes without saying that we have to compute two items for the realized gross profit this year and prior year. For this year's gross profit rate, remember that's just going to be the basic computation, that is sales minus cost of sales equals gross profit. And if we divide the gross profit by sales, we get the 38% gross profit rate. However, for 20x1, which is prior year, again, the formula is deferred gross profit beginning divided by the installment accounts receivable beginning at 600,000. And prior is 270,000 DGP. So that we'll get 45%. If you look them at the problem, here is the deferred. And what about the installment AR beginning? That is here, 600,000. It's given also. So we get 45%. Now we can do the computations. Oh, this is quite long, but then we can just subdivide. Firstly, we should know how much is the realized gross profit from regular sales. I will get that first. This is given times 30%, which is also given. That's the realized gross profit for regular sales. What about for installment sales? We have here 2,125,000 that is given. Let's go back to the problem. It's quite long. And you have here ending balance of the receivable. So that is 1,125,000. That's collections in 20x2 from 20x2 installment sales. So again, for current year or this year sale, the difference between the installment sales, which is equal to AR at beginning minus the ending, that's the collections, times 38% here as computed, and that's going to result to 427,500 RGP in 20x2. Now, what about for 20x1? There is a 600,000 beginning balance, right? That's 20x1, December 31, 20x1. The ending of 20x1 is the beginning in 20x2. So that's why we have here 600,000 minus the ending in 20x2, 75,000. However, there is a stated item here that this is the balance of the AR that was related to a repossessed inventory. So this was written off. Therefore, this has to be deducted. And that's what I've told in the other sessions, that normally the difference between the beginning balance of AR or accounts receivable and notes receivable and the ending would be the collections. If ever we don't have accounts written off sales discounts, sales returns, and allowances, among other things that would reduce the balance of the receivables. So we are going to deduct this one also, so that the collections in 20x2 from 20x1 installment sales is this amount times 45% as computed here, and we will get this particular amount for 20x1 sales. And we end, so that the realized gross profit from installment sales is 646,313, and we add that to realized gross profit from regular sales. This is the amount. Oh, quite a problem. It's really going to test our understanding. But if we just know about the formulas, then it will be easier for us. However, the learning points here as we go back is that if we are going to compute the cost of sales here, it's going to be entirely both for regular and special in the form of installment. If ever we segregate the two, then the cost of goods sold will be for regular and installment. Then we can compute the gross profit rates in current based on the classic formula, sales minus cost of sales equals gross profit. But for prior years, that would be DGP beginning divided by installment AR beginning. And for multiple years, then we are going to compute separately. If there are 2 years, so 2 years section for realized gross profit. If 3 years, 3, and so on. Then the realized gross profit total should be coming from installment and regular. Okay, what about gain or loss on reposition? So the formula, basically the formula is just our balance, 15,000 given, which is the fair value of repossessed merchandise, then less unrecovered cost. So take note of the formulas, guys, because we have so many formulas already. But for reposition, that is at 15,000, that's the fair value of repossessed merchandise wherein it should be recorded at its fair value, less unrecovered cost, which is the difference between the installment accounts receivable and our deferred gross profit rounded off. So that's going to be unrecovered cost. The result would be ending with 2, right? So 15,000 minus the difference of these two would be equal to loss on reposition. So there is a difference. I wrote here 6,312, probably because of rounding off of numbers. If this is 3, this wouldn't be balanced anymore because this would exceed by 1 peso. Therefore, this should be 6,312. Anyway, if there are choices in the problem, it's going to be easy because we just have to pick the choice, and the choice must be the closest to what we have computed. However, if it is going to be open-ended or blank, then it's going to be really the entire amount we are going to pay. So we have to be careful of rounding off of numbers and instructions given by the teacher. All right? So hopefully you learned something for today, especially for this part. And the next section would be cost recovery and the summary. Okay, so hopefully you are going to share this particular video so that more people will know. And don't forget to subscribe to my channel, and I'll see you next time. Bye for now.